Hello and welcome to our discussions on the International Financial Reporting Standards. We'll make an effort to explain in brief the various provisions of the IFRS. In this session, we pick up the IFRS 2, which is share-based payment. In the first part, we'll just focus our attention on the standard and its interpretation. In the second part, we'll pick up few examples to explain the application of the IFRS 2. IFRS 2 deals with the share-based payments. So a share-based payment is a transaction in which the entity receives or acquires goods or services either as a consideration for its equity instruments or by incurring liabilities for the amounts based on the price of entity shares or even the shares of other entities where the initial entity has interest, or in other words, other group entities too. So this standard is applicable only if the entity receives goods or services or for the payment towards the goods or services. If the shares or cash is paid to any person in the capacity of equity shareholder, then in that case the IFRS 2 is not applicable. For example, this standard is not applicable in case of issue of bonus shares, because the shares are issued to a person in the capacity of the shareholders. But if the shares are issued to purchase the stock or purchase fixed asset, or shares are issued as a part of managerial compensation, then this standard is applicable. The accounting treatment of the equity-based transaction will depend on how the transaction be settled. That means the transactions can be settled by issue of shares. Either it can be settled by the issue of shares or can be settled by cash or a combination of equity and cash. So the accounting treatment of the equity-based transaction to a large extent depends on how the transaction is settled. If the transaction is settled by issuing shares, or whether the transaction is issued by the cash, but the value of the transaction depending on the value of the equity, or an option is given whether the transaction can be settled in cash or shares. If the transaction is settled in cash or equity or an option given on cash or equity, questions should come to our mind: when will this transaction be recognized? The transaction will be recognized whenever the goods or services are acquired, when it obtains the goods or services, or when it obtains the asset. The entity shall recognize a corresponding increase in equity if the goods or services were received in equity settled share-based payment. But if the payment is made through cash, then a corresponding liability has to be created. Let us see the transaction to understand this particular treatment. If it is equity settled, then the journal entry will be asset or expense debited to the equity. But if it is cash settled, then asset or expense to the liability. We may ask a question, when will be asset or an expense? The standard says, when the goods or services received or acquired in a share-based payment transactions do not qualify for a recognition as an asset, then they will be recognized an expense. So there is an interpretation there, or subjectivity. You have to decide if the goods or services is not an asset. In other words, the benefit will continue for a longer period, then let us call that as an asset. If the benefit will expire in the current year, treat that as an expense. So asset or an expense debited to equity, or asset or expense debited to the liability. So this is at the time of recognition or initial recognition. Then the question comes, what will happen at a subsequent recognition? What will happen to this liability or equity? So the subsequent recognition depends on whether it is an equity or cash settled. If the share-based transaction is settled in cash, the IFRS 2 says the goods or services received or the liability incurred are measured at the fair value of the liability. And this fair value of the liability is remeasured at each reporting date. So let me come back to this entry. If it is a cash settled, the value of this transaction will be the fair value of the liability. And this fair value of the liability will be remeasured after on every or subsequent balance sheet date. The fair value of a liability is remeasured, and such changes, if any, in the fair value will be shown in the income statement. But if it is equity settled, then the recognition will be the goods or services received and the corresponding equity are measured at the fair value of the goods or services received. You see the difference. Here it is a fair value of the liability, whereas it's a fair value of the goods or services received. So in this case, the value of the transaction is the value of the fair value of the asset or an expense. In this case, the value of the transaction will be the value of the liability. And in this case, the value of the liability will keep on remeasured, whereas in this case, it says the fair value of the goods cannot be remeasured and the subsequent changes of the fair value are to be ignored. So there is a difference in the value of the transaction itself based on equities, depending on equity settled or cash settled. To recap, in equity settled, the transaction is valued at the value of the asset or expense, with an exception that if the value of the expense cannot be determined, then the fair value of the shares. But in case of a cash settled, the value of the transaction will be the fair value of the liability. So questions should come to mind. Will the value of the transaction change, be different, depending on the value of the liability and the value of the asset? In other words, will the mode of settlement have an effect on the value of the asset or an expense, which we'll pick up which we'll examine when we take up some questions. Moreover, in a subsequent recognition, the value of the liability will keep on changing, whereas the value of equity will not. One of the reasons for this difference in the treatment is that liability comes under the definition of financial instruments, whereas an equity is not under the financial instruments. So, according to financial instrument accounting standard, the liability has to be revalued. Subsequent balance sheets too, and the changes in the value of the liability should be shown in the income statement. But whenever there is an equity settled transaction, most of the time there will be some vesting conditions, fulfilling of which only the shares get vested with the party. If there is no vesting condition, then the goods or services are recognized immediately and a corresponding increase in equity takes place. But whenever there is a vesting condition, the goods or services received and the increase in equity will happen over a period of time. In other words, if there is equity settled and there is a vesting condition, then asset or expense to equity can happen over the vesting period. And these vesting conditions may be the service conditions or performance condition. Service condition, like you have to continue to work in the company for a period of 2 or 3 years or n number of years, and the performance condition may be based on the top line, revenue or bottom line, variations of profits, or even market prices. Then now we'll see if there is an option of settling the transaction with cash or equity. In this case, the accounting treatment depends on whether the choice is with the entity or with the party to whom the payments has to be made. If the choice is with the entity, then the past practice of cash settlement, or if the entity is prohibited to issue the share, then it will be treated like a cash settle. That means on the date of recognition, if there is an option with the choice is with the entity whether to settle the transaction through cash or equity, then on the date of recognition, the treatment will depend on the past practice. If the company has been settling the transaction through cash, then treat it as a cash based equity, cash settle equity based transaction. Or if the company is prohibited, that means they cannot issue the share, in that case also it should be treated as the cash equity based cash settle transaction. Otherwise, treat it like equity settled cash based transactions. Equity settled share based transactions. But if the choice is with the party to whom the payment has to be made, then there is complex treatment as per the accounting standard. It says this should be treated like a compound instrument. A compound instrument is one which is a combination of debt and equity. So if an instrument has a component of debt and equity, then one is required to use the split accounting. The split accounting says on the date of issue, the transaction has to be divided into debt and equity. But how to do that? First, find the fair value of liability. Find the fair value of the asset or expense. Deduct the fair value of liability from the fair value of the asset or expense, which will be treated as the value of equity. So if the choice is with the party to whom we have to make the payment, so there is an obligation on the part of the company. If the party asks for cash, they have to settle it by cash, and then it becomes a liability. And if the party asks for shares, then it has to settle it through equity. So on the date of the transaction, the company is not clear, but company agrees to take up this obligation, and that may end up as cash settle or equity settle. So there is a compound instrument involved, and in case of compound instrument, there's a need to find the value of liability and find the value of the equity involved and treat it accordingly. So to recap, we said that the equity-based settlement to a large extent depend on whether the settlement is in the form of shares or settlement is through cash or a combination of cash or shares. But in all these cases, whether it is equity or cash or a combination, the value depends on the value of equity. So therefore it is called equity based transactions. However, settled in cash or equity or a combination. And the treatment depends on equity settled or a cash settled or a choice. If it is equity settled, the value will be on the fair value of the assets. If it is cash settled, the value will be the fair value of liability. So in later sessions, we will try to take some examples and understand the implication of this standard on the financial statements. Thank you very much.